You open your screen this morning, and after the chaos of yesterday, you see it. Gold is holding steady, well above $5,300. Silver is back over 111. That gut-wrenching plunge, the $500 crash in gold, the swift double-digit drop in silver. It feels like a bad dream that's starting to fade, but you're left with the lingering question, what on earth was that? The talking heads will give you a dozen reasons, but I need you to see the single thread that connects it all. While everyone was fixated on red candles and panic, they missed the crime scene. That wasn't a change of heart about precious metals. That was a forced mechanical liquidation, a financial accident with gold and silver as the collateral damage. And understanding this distinction is absolutely critical because it tells you everything about what comes next. Let's reconstruct the moment. Yesterday morning at 9:30 Eastern, the tech-heavy Nasdaq opened under severe pressure. Microsoft, a titan, immediately plunged. By the close, it was down nearly 12%, wiping out over $350 billion in market value in a single session, one of the worst days in its history. Now, watch the clock. Between 9:45 and 10:30, gold, which had been trading near $5,600, suddenly and violently dropped $490. Silver followed the same terrifying V-shape. This was not a slow, fundamental reevaluation. This was a flash crash. The timeline is the smoking gun. Gold did not fall because of geopolitics or inflation data. It fell because, at the exact same moment, a specific group of large holders were getting a catastrophic margin call. Here is the mechanism, confirmed by multiple trading desks and analysts. Hedge funds, heavily leveraged in soaring tech stocks like Microsoft, faced immediate demands from their prime brokers to post more collateral. To raise that cash instantly, they dumped their most liquid, profitable holdings. At the very top of that list, gold and silver futures contracts. This was a cross-asset fire sale. Gold became an ATM for speculators in trouble elsewhere. The sheer size of the forced selling hit a market where, critically, the liquidity had already begun to vanish. This leads me to a point of personal speculation about how this crash achieved such breathtaking speed. It wasn't just the selling, it was that the buyers, the major banks and market makers who typically provide stability, stepped away. When volatility spiked to extreme levels, these entities, already constrained by banking regulations, simply widened their bid-ask spreads to absurd levels and refused to provide meaningful liquidity. They let the market fall into a vacuum. This created a scenario where sell orders, particularly the automated stop losses of retail traders, executed at rapidly lower and lower prices with no cushion. The crash was not just triggered, it was actively amplified by the withdrawal of the usual shock absorbers. This is the kind of market anatomy we dissect here, looking past the panic to the plumbing failure that caused it. If navigating these structural tremors is vital to your strategy, then joining this community as a subscriber is the best way to ensure you get this analysis when it matters most. Now here is the most beautiful part of this ugly event. The trap failed. The crash was designed to trigger panic, to force the weak hands to surrender their metal at a generational discount. But it didn't work. By yesterday afternoon, the entire move had reversed in a dramatic V-shaped recovery. Gold closed near $5,379. Why? Because while paper traders were fleeing, physical and institutional buyers saw a historic opportunity. Reports confirm that in China, gold flipped to a premium over the global benchmark. Indian investment demand surged. Even gold ETFs saw inflows, not outflows, on one of the worst price days in years. The physical market absorbed every ounce the paper market dumped. This is the ultimate tell. If the fundamentals were broken, the price would have stayed down. It did not. Let's be clear, none of the pillars supporting this rally changed yesterday. Central banks are still buying. The US dollar is still at multi-year lows. Geopolitical tensions from the Middle East to Washington are still escalating. The US government faces a high probability shutdown this very weekend, a classic catalyst for safe haven flows. The crash was a technical event, a seizure in the system, not a change in the story. This brings me to my final assessment. The violent shakeout served a perverse purpose. It reset overstretched technical indicators and flushed out speculative leverage, creating a healthier base. It was, as one major bank termed it, a mid-air refueling. For those who held through the storm, Your conviction has been validated. For those waiting on the sidelines, that plunge offered a rare and brutal discount to enter a market whose fundamental drivers are more powerful than ever. So, as we look to Monday, understand this. The manipulative attempt to break the market spirit backfired. It demonstrated instead the incredible underlying demand waiting for any dip. The system showed its weakness, but the asset proved its strength. They crashed it, and it got right back up. That should tell you everything you need to know about what happens next.